often I think the thing with entrepreneurs, and I've also been guilty of that, is that you don't know what you don't know.
Me too.
Right. So I think surrounding yourself with people where you're like, oh, these are areas that I don't know about, and they can help me identify areas that I don't know about.
Yeah.
That compounds, and that's super powerful.
Welcome to the Found and Funded podcast, a podcast for searchers by search experts where we explore the route to business ownership without having that $1 million idea. I'm your host, Carl Lundberg, CEO at Gerald Edelman and founder of the ETA Awards. Let's get into it.
Yes, we've talked about this. Bit of a loaded question.
Because my next question might have been, what's the answer? But I don't think that's unfair.
Yeah. If I knew.
Yeah. This time we have Joyce Mackenzie Liu, founder and CEO at Pegafund and seasoned venture capital and PE investor. Joyce, great to have you on. It'd be great if we could start by perhaps you just give us a bit of background about your career and how you ended up sitting here with us today.
Thank you, Carl. Love being on this podcast with you. So I started the first 10 years of my career in the private markets, worked closely with U.S. pension plans on asset allocation strategies with a particular focus on alternative asset managers, which VC funds, PE funds, and also search falls under. And then I spent quite a number of years in structured finance, really raising capital for companies across different industry sectors before moving to the buy side at Ares to really invest in PE-backed software companies. About 10 years ago, I moved over to London, to Europe, and ventured more into the early stage ecosystem as a venture lender, as a venture equity investor. And it was through my experiences working closely with the portfolio companies that I realized that there was a big market need for ultimately professionalizing finance functions and the overall go-to-market function for scale-ups, which is what we do today at Pegafund.
Brilliant. And so a lot of your time then, I suppose, since then has been spent with working with tech and other early stage businesses.
Yeah.
Perhaps you could tell us a little bit more about your involvement in those, what you do at Pegafund and how you assist them.
Yeah, sounds good. So at Pegafund, what we do is we provide fractional CFO services to indeed technology companies, some of whom are VC backed and others are bootstrapped. We very much focus on businesses that are in that 30 to 200 full-time employee stage. And they're going through a lot of change and transformation in really refining their revenue, their commercial model and go-to-market motions, which means that things like strategic finance, revenue operations, ultimately planning around customer unit economics, around the people that they bring on board is really, really critical. And oftentimes the businesses we get involved in, they're missing things like management accounting.
Yeah.
Similar to early stage businesses in the search fund space. They're missing a really good understanding of their customer segments and which ones are predictable as they grow and scale and which ones are experimental. So we help them really think about that in the context of different funding options and help them really build the foundations in place to continue to grow and scale efficiently, but also at a model that fits kind of the VC path.
Brilliant. Okay, so it sounds like there's an element of kind of financial involvement, planning, assisting with growth and development, but as well as that, perhaps a bit of coaching of the individuals in the business as well, who perhaps have a bit less experience of operational management. Is that fair?
Yeah, exactly. It's very much focused on the entrepreneur and ultimately helping the entrepreneur transition from wearing many hats, where they're doing product, where they're doing marketing and sales, to a CEO of a business that has lots of different functions, specialisms, and really building that kind of mid-management layer. Mm-hmm. And that transition isn't easy, right? Because often entrepreneurs by nature are stubborn and they want things, a certain way. But as they continue to grow in business, they need to double down on the areas that they know really well and decouple themselves and hire like that next level of talent in areas that, there's others that have done it time and again before.
Yeah.
And I think that's the unique thing about working with companies at this stage is that you're working with both the business, but also the entrepreneur or entrepreneurs themselves. And the two are very much tied hand in hand.
Definitely some similarities there with the world of search, but I think we'll come on to that in a little bit. What's interesting there is actually that with these founders, particularly in early stage businesses, I think there's probably a slight difference, although some of the same challenges are likely to be there, in that if you've got a founder, they're obviously going to be entrepreneurial, but they've also probably got this sense of ownership. This is my baby. I need to control everything, which they probably do at the beginning.
Yeah.
And you need to, as you say, decouple, detach them from that. Look, actually, you need to stop being someone with deep involvement in every minute detail of the business to becoming a leader of something.
Yep.
If you're going to scale. I suppose there is an element of people learning that process in search, but they probably need to do it slightly more quickly because they're going to be dropped into a more mature business.
Correct.
And immediately be a leader. Perhaps you can talk to that point slightly.
Yeah, I think that to your point, like Carl, the coaching element, working specifically with the entrepreneur to really help them think through just on a very practical level, right? Like, what is my task list this week or this month? What are the key priorities? And making sure that they really focus on the tasks that are really going to move the business forward, and the ones that maybe are less urgent to kind of remove themselves from that over time by actually having specialists take those on. Because as a founder CEO, if you're doing the same things that you were doing a quarter ago, that probably means like the business is not growing as fast as it could be.
Yeah.
And I think the biggest difference between like the VC world and the search world in terms of the businesses is, to your point, like you're coming into an established business, right? So like clearly the business has already worked in a way that is producing value and cash flow to its existing customers. And so you need to ultimately preserve and protect that, but at the same time still start making changes that can really drive the growth in the revenue engine. And that could be a combination of organic growth, which in VC-backed companies, it's almost all organic growth in the beginning.
Yeah.
Or it could be a combination of inorganic growth, right? Looking at smaller tack-on acquisitions. Maybe you're building out channel much earlier than doing direct sales. Maybe you're looking at other types of products and service offerings, where VC-backed companies, they tend to look more for geographic expansion. So I think the routes to growth in these two models are different based on the stages of the business that you're coming into, and also the industry vertical. But that at the core of it is like building that strong mid-management layer, right? Like your second bench. It's critical to any business at this scale, because that's how you build operating leverage into a company and continue to support growth. Yeah,
agreed. Completely agree with that. That's great. So obviously your background's in VC and PE. How did you first hear about the world of search and entrepreneurship through acquisition?
Yes, very, I guess serendipitously. So I studied at Ivy Business School in Canada, and two of my alumni mentors had done a search in Canada back in 2013.
Okay.
So they acquired a business which actually just recently exited, called UCIT, if I remember the name of the business correctly. And it was owned by a father and two sons. And their whole thesis back in the day was that, I think similar to, what we're going to talk about in the UK and Europe market, is that there's a shortage of financial capital at the early stage for SME businesses. And often a lot of these businesses are suboptimally capitalized from a leverage perspective. Which also presents an opportunity for entrepreneurs that want to take that risk. They didn't want to start a company from 0 to 1, which is typical in a tech startup environment. They thought actually it's a better use of our skills to acquire an existing business. So they worked with the father and two sons of this business to basically expand the company across Canada, ultimately went to the US, and then built global operations. So if I remember correctly, they started from about 55 people, and now the business is over 3,000 people globally. Wow. So created a lot of value through that process. And I had recently, about a year ago, reconnected with them, learned about their journey.
And what sort of time period was that over, that growth?
That was from 2013 to 2024.
Yeah.
So over a 10-year period, which is incredible, right? Like you don't see that kind of growth even for a lot of VC-backed companies. It's really difficult to do that. So that's what initially intrigued me. And then I had additional conversations with Rob Turin and Eric Mickelson, who are the co-founders of that business. And actually Rob has since moved, or is in the process of moving, to Italy, and sees kind of a potentially similar opportunity here in UK, Europe.
Yeah. Wow.
Yeah.
Okay. And so just to dive into your experience in VC and PE, it'd be useful if you could explain some of the key metrics or the key pieces of analysis that you do when making an investment decision in those worlds.
Yeah. Great question. I think VC and PE have a lot to actually learn from each other, and people that have worked in both roles will have different perspectives. In that, when I worked in structured finance and PE at Ares, a lot of the work centered around what I would consider quote unquote financial engineering. So it's how do you structure the deal in a way that best allocates capital for the business, right? And removes a lot of potential risks in order to also not only protect on the downside, right? Like if something goes wrong, like how do you make sure you get at least your money back, but also provide some sort of upside opportunity once that risk is de-risked. So it's a lot around, I would say, balance sheet optimization, cash flow optimization, and of course, working with the right PE sponsors. So at Ares, we worked very closely with the likes of Thoma Bravo, Vista Equity, Hellman Freeman, who are big software sponsors in the West Coast. That also mattered because you knew that they were very good at going into businesses and essentially restructuring it so that you could expand EBITDA. So private equity is a lot around financial engineering and having access to companies that are not resourced or both from a capital perspective and from a people perspective optimally.
Yeah.
The VC world, on the other hand, is very focused on P&L, and particularly, I would say, the revenue engine.
Yeah.
Right. And so it's very, if you think of the different financial statements, yes, cash flow is taken into account. Yes, balance sheet is taken into account. But the presumption is that this business is serving a market that's big enough that you can experience exponential growth. And if you hire the best talent in this space and, at a certain cost level, then you can ultimately drive to that exponential growth. The industry is also very much focused on this concept called power law, which is that there's very few businesses that generate outsized returns. So even if the other, companies are great companies in itself, but don't fit the VC model, you'll still make your returns on the fund based on the top 6% of capital deployed, which typically generates 60 to 70% of the fund. As a result, I think VCs look a lot at understanding a market opportunity, the value chain. Where should you play in the value chain? The timing around a market and the maturity thereof, right? So if you're too early to market, you're probably going to spend a lot of marketing and sales dollars or euros or pounds to ultimately drive that demand. What you want is to be in a market where there is inertia and organic demand coming in for a particular product, and therefore you can ride the wave of that. And so that means really understanding a lot of the playbooks around the go-to-market engine and the commercial model and the business model. It tends to be, of course, for every average there are exceptions to it, but there tends to be less of a focus on balance sheet optimization and cash flow optimization, right? Except for maybe the last 1 or 2 years because we've had a financial market correction. And I think there's merit and value in both of these emphases. Like I think we're living in a world where it's a lot less about net new. It's a lot about repurposing what exists today, which means you need to think about liquidity. You need to think about cash management. You need to think about where is there value, and value is not like optimally set up. And you still also need to think about revenue growth. Right. With we can get into a whole another topic on this, but with the proliferation of big data, RPAs, LLMs, AI, like it's the economies and how you grow and scale a company is fundamentally changing, right? And the people that have access to resources, both in terms of, strong balance sheets, but also in terms of data and trusted relationships, they're the ones that are going to have an unfair advantage going forward. So I think all businesses, all individuals need to think about how can we repurpose more of what we have already.
Yeah. Yeah, brilliant. Very interesting. I think there's a point there, though, about, the capital structure of early stage businesses.
Yeah.
There are less options available, than more mature businesses. And I think, availability of debt is not great in early stage businesses. Putting aside, other things that we may talk about, perhaps in the UK debt market generally a bit later on. But there was this phrase, and I'm sure you've heard it a number of times. Probably a few years ago it was more popular, but equity is the new revenue. People were going out raising money, and there was all this money sloshing around into ventures.
Right.
But actually, I'm not sure anyone was. It seemed to be just that we need to deploy cash. Let's just pump it into these businesses, and there was no thought process about capital structure. It was equity goes in, it gets spent. We raise more,
Correct.
It gets spent.
Yeah.
And I think it's a very good point to say, actually, if we think more about the capital structure, the balance sheet, and actually where is this going, probably we'll get, there'll be less money going into these ventures, which may not be a good thing, because some of them could fly, and actually some businesses that perhaps would have done very well actually wouldn't be able to raise the money. But I do think that, as you say, it's unsustainable to just keep funding these businesses with equity when they're not revenue generating.
Yeah, I mean, it's taxpayer money at the end of the day, right? A lot of it is taxpayer money, and ultimately we all care about our pensions in the future. I mean, you and I are both still young.
Yeah.
But it's really like, and I don't want to sound negative here, but we've come from like 20 plus years of globalization. We're now going through deglobalization, and that has a lot of first, second, third, fourth order degree consequences, which is not just that capital, the cost of capital and borrowing money has increased. The cost of production has also increased, right? And along with that, cost of labor. And I think those are things that are going to, and then, as a continent, we're going through energy transition as well, which has all sorts of consequences. So I think all those things in general mean that it is going to be harder for small businesses to really thrive and grow unless there's fresh perspective brought in.
Yeah.
Right. And then unless these businesses are also capitalized in a way where it makes sense for the risk reward of what they've been able to demonstrate over 10, 20, 30 years.
Yeah.
And so that's where I see the opportunity is. And I think you're absolutely right that there should be sort of accountability behind where money is being spent, right?
Yeah.
You don't take a mortgage for a house without knowing that you can, hopefully,
Yeah.
that you can pay the payments every month, right?
Yeah.
And I think in many ways, fund management is the same.
Okay.
Yeah.
And just to continue that point, really, about the VC stuff, the type of targets that, VC funds will invest in versus the type of businesses that searchers look to acquire are fundamentally very different, right? So VCs tend to be very early stage with massive growth opportunity, almost kind of make or break, it's 100 or zero. Obviously there's some in between as well, but obviously searchers tend to look by definition for more stable, mature businesses that are cash flow positive. What's your view on the differences there, and how do you turn? I know you've got some PE experience as well, which search is probably more similar to, but very different worlds, and how do you reconcile that?
Yeah, so it's so interesting because since looking, going deep down the rabbit hole in February of this year, looking into this asset class and speaking to probably like 200 plus different people in the ecosystem and really learning a lot through the process, I do look at search as a combination of both PE and VC investing, both in terms of how you think about risk reward, but also how you evaluate opportunities. And the reason for that is because these companies are still small in nature, right? Like the total number of employees within a search-backed business is usually, maybe a few hundred at most. which also means things like having, mature systems and processes to grow and scale is still heavily dependent on the existing owners in the business and perhaps the up and coming mid management. So that means, yes, you do need to, in the same way that you look at VC investments, you do need to look at the industry vertical, the customer base, and how that impacts quality of revenue at the end of the day, as well as the people in the business and how if an owner, let's say, looks to transition out within 1 to 3 years, like how dependent is the quality of revenue on that owner, right?
Yeah.
How much of it is based on the product itself or the service itself versus the individual who's been servicing those customers for 10, 20 plus years. And I think that the market does matter in the sense that you also want to be in a market that is going to be compounding in terms of growth. And you continue to see that going forward, and there aren't some fiscal or regulatory or other types of pressures that might impact the quality of the revenue at the end of the day. So I think that is very similar to VC. And if I talk to search entrepreneurs in this space and how they source investment opportunities, that funnel is very similar to a VC, right? Super top of the funnel heavy. You need to do lots of outbound motions. Okay, maybe not through LinkedIn, but you send mails, and then you attach a pen to it so that you can capture the attention of the potential small business owner. But that funnel conversion is very high top of the funnel and very small conversion at the bottom of the funnel. So it's very similar to how VC sources. I think the big difference, though, is that these are businesses that don't require money. Whereas, startups and VC companies are dependent on external money because often they're cash burning. So then I think to convert to a deal or an acquired business, you really need to understand the psychology behind the small business owner and why they're selling, because often it's not only attached to how, they think about their retirement financially, but it's so attached and ingrained in the personal identity of that individual, right? And they say, like in Japan, for instance, that for search entrepreneurs, they're actually adopted into, like legally adopted into the family of the small business owner.
Right.
So that kind of tells you, the kind of how deeply ingrained and important it is that the business is integral to the identity ultimately of the original business owner and entrepreneur. And that's not necessarily dissimilar to VC-backed companies, but it is a different generation, right, with different motivations and different ways of working. It's similar to PE in that price matters and terms matter, right? So I think this industry works when you invest at the right price. With anything buy low, sell high. And also financial engineering from a leverage perspective also matters because you want to benefit from, essentially using existing cash flow to service debt at a more cost-effective way than raising only equity for the capital in order to accelerate growth. But at the same time, you need to make sure you don't over-lever the business, right? Because going through an ownership transition can be is disruptive to a business, right? And I've heard from some of the conversations that I've had that it's not unusual in the first 1 or 2 years that sometimes EBITDA declines. Because the companies or the business is going through so much change. So
people talk about a hockey stick, don't they?
Exactly.
There's going to be a dip, and then hopefully,
and then it picks back up. Yeah, exactly. So there is still, you want to use leverage, but you need to use it in a way that's healthy, and that means really deeply understanding enterprise value and the risk reward around how you drive that for growth going forward. And it means also understanding, I think concepts like operating leverage and financial leverage, which is classic in the PE world as well. So I do think you need to combine both these thoughts. But what gets me really excited is if you look at the historical data, and we can get into a discussion of, data bias, survivorship bias or not. But like on a risk reward perspective, it doesn't have the power law dynamics that VC asset class has. It has historically provided outsized returns compared to both VC and private equity on average. Right? And yes, you need a diversified portfolio of investments, but not necessarily so much so compared to VC because you don't have the power law dynamics. But you can still generate higher returns than you would in private equity.
Yeah.
Right. And then we can get into also a conversation of, well, is that because this is an emerging asset class and historically there hasn't been tons of institutional funding in this space. Therefore, you are buying companies at attractive valuations, right?
Yeah.
So I think there's a little bit of that dynamic going on. But at the same time, you could argue that, well, there's tons of private equity funds out there today.
Yeah.
So if you can do the hard work, roll up your sleeve, get into these companies, really polish and refine their growth engine, that there will be private equity buyers in the future. And I think, often in traditional search, you go through recaps during the course of the journey.
Mm-hmm.
And if that continues to be the case, and I do think there is more and more consolidation happening in the private equity industry, then there is going to be ultimately both financial buyers and strategic buyers for the underlying business.
Yeah.
But it's doing that hard work, which traditionally private equity isn't really suited to do.
Yeah.
Right? Because they're suited to kind of deploy capital in quote unquote fixed boxes.
Yeah.
And it has to look a certain way. It has to be quite structured, just given the check sizes of those funds and the holding period and the return on capital around that.
Yeah. Yeah. No, really interesting. Lots to unpack there, but I think definitely there's some parallels drawn there between kind of the VC and the search world. Definitely the kind of the seller reliance piece in owner managed businesses, which these tend to be, the targets tend to be, is not dissimilar to the reliance perhaps on founders in early stage businesses. And I think that there is a process of managing that. Definitely. It's really interesting about that point in Japan, where they actually bring them into the family formally, which is that's amazing. I think also there's a point that I picked up on there about kind of the outsized returns that have been achieved. To some extent, yes, probably there's fewer people fishing in this part of the world, in the market. Probably that's less pronounced in the UK. I think there's quite a lot of people in the lower mid-market space, huge number of private equity businesses in the UK, given its size and the size of the market overall. But actually, I think some of these outsized returns are down to the involvement of how the Stanford model works. In that, there's kind of this analogy of the horse, the jockey, and the coach. The horse, of course, being the target company, and the jockey being the searcher, and then the coach being the investors. And so historically, the investors, the traditional kind of the cartel, as it were, as I affectionately call them.
OGs.
Yeah, the OGs, that's right. But they're quite hands-on. You've got these very experienced investors and very experienced operators who effectively guide a searcher who's perhaps a bit fresh and not as experienced, maybe fresh out of an MBA. They guide them through. And so really what you've got is these businesses perhaps often run by people who have very hard workers and done well, but not hugely huge amounts of business acumen necessarily, or at least not huge amounts of academic business acumen or theoretical business acumen that can be brought to the party by the searcher who's perhaps come out of an MBA. But then you've got all these other these ex-searchers and VC investors and others who are this collection of investors in the space who are guiding this individual through and giving them real hands-on advice and experience where they've done it before. So, I suppose you would expect there to be better returns because you've got a very experienced and very well-skilled group of investors perhaps sitting on the board and coaching these people through. That isn't sustainable, right? It's not scalable at that level. And obviously there's a lot of institutional money in the space now where they're not going to be providing that same level of input. So perhaps we're going to see those returns dip slightly. I think they've got quite a long way that they can move before it's unattractive. And also you mentioned a piece about growth and also a piece about value. And some people we see looking for that kind of hockey stick, that J curve to say, look, I really want this to fly, this huge growth opportunity. And I see others saying, actually, I don't really need it to to grow that much. All I want is it to delever over time, and I want to buy it cheap. You know, if I can get in at 3x or below, which I've seen people do, it doesn't happen often, then it doesn't really need to grow that much because I have barely paid for it. So there's loads of different angles here, and that's what I find fascinating about it, because I think all of them are hugely exciting, and create great opportunity for the searchers and the investors, right?
Yeah.
If there's searchers out there listening, what skills do they need to demonstrate to an investor that would make you think, yeah, do you know what, this is the right person?
For me personally, definitely deal making. I think deal making is as much of a science as it is an art, right? So and because the funnel in a search process is similar to VC in that, you know, you need to do, we've heard outreach of like 2,000 to 5,000 companies, and with the hopes of getting to like, you know, 50 to 100 meetings, management meetings, with the hopes of getting to like anywhere from like 1 to 4 deals, where you hope to deliver heads of terms, which then become exclusivity. That funnel is so wide at the top of the funnel, that I think having gone through deal making before, where you're used to sourcing very quickly, knowing how to filter and move to that next stage, and ultimately knowing how to spend your time wisely, is really, really important. And I think it's something that is harder to teach and easier to learn by practice.
Yeah.
So definitely, I think personally would over-index more on that. I think having domain and industry expertise is also very valuable, because then you can speak the same language as a small business owner, and it helps shorten that process in garnering deep trust in each other. You know, I think especially for businesses that tend to be more technical or engineering centric, if you can, and if the owner has also been someone who is technical engineering centric, like having ease of communication in that transition process will not only help with the due diligence, but it'll also help with the post-acquisition transition as well. And then I think the third is like just having a very clear thesis of why are you, or if it's, you know, a dual search, why are you going to win in this space compared to, you know, some other searcher? Like, what is your competitive advantage? And for everyone that's different, but I do think knowing like where your core strengths are, be it, you know, soft skills, hard skills, network, capital, etc., is really critical, because it allows focus of time.
And also knowing where your skills aren't.
Yes, and also knowing where exactly where your skills aren't, so that you hire for those as well, right? Because often I think the thing with entrepreneurs, and I've also been guilty of that, is that you don't know what you don't know.
Me too.
Right. So I think surrounding yourself with people where you're like, oh, these are areas that I don't know about, and they can help me identify areas that I don't know about. That compounds, and that's super powerful. So one of the comments that you made earlier, which I like a lot about this industry, is that it is very much an industry centered on entrepreneurs for entrepreneurs, right? That transfer of not only like, you know, value created in a business from one generation to another, but also that experience and expertise of having actually run and operated and acquired a business before, which is very unique. Right. I think it's different to manage someone's money and then deploy it on their behalf versus like your own money. Right. And taking the risks attached to that. And I think as a result, that creates just more empathy for when you know, when things go right, like everyone's, you know, happy days, everyone's, you know, happy. But it's like when things go wrong, like you want someone who's going to jump into the muds and the trenches with you to really help work out of that. And I think someone who's been an entrepreneur in a particular domain, in a particular geography, will always provide a lot more value in those situations.
I think it's an interesting point, and one that we've touched on before. In fact, the first episode of this series, when I was talking to one of my partners, Will Abel, you know, he said the searchers really are putting everything on the line, because even if they're not putting in their own cash, they're probably giving up 10 years of their life 10 years of their career.
Correct.
It has to work for them. So they have to be fully committed, because you don't want them halfway through thinking, oh, I've sort of changed my mind now, and that's it.
Not just like a job that you can switch from
absolutely.
one.
You don't want them in it for the salary, right? That's not what it's about. So and also what's interesting is that often when I talk to people about, the pros and cons of a deal making skill set versus an operational skill set, we always land on what's more important is operational, because you can buy in the transaction skills. But actually what I find very, very interesting, and actually it ties into some other things people have said, but without directly addressing the point, is that it is a massive task to get from this huge number of possible target entities to filter it down to probably 4, right? And actually, if you can't do that, if you haven't got the skills to do that, and as you say, it's something that you need to learn on the job. So if you haven't done it before, you're going to be spending quite a lot of your, particularly traditional search, even self-funded, a lot of your time, and let's say you've got a 2-year time period, if you need a year to learn how to do that, you're a year behind. You've halved your time. So it's a really important point that actually having some experience of that, or knowing that you don't, is very important.
Yeah, and I'm filling the gaps around that. Yeah. And I guess on that particular point, I'm also a little bit biased in the sense that I think sourcing arguably is the most important, because if you select the right business and you structure the deal correctly, then you can actually protect a lot around the risk and just spend all of your time and energy on really driving the growth.
Yeah.
But if you end up choosing to invest or acquire a business that is like not the best asset or business, it's hard to work your way out of that, even if you've had good terms and maybe decent price to that effect. But it's just I think that's one of the things I've learned through venture is like, there's usually a reason why the winners are the winners, and there's usually and you usually know this within 6 to 12 months after the investment, which companies are going to be the ones that make it, and which are the ones that probably aren't. And it's usually the mid layer that's much harder to figure out.
I think it's fairly well there's a strong consensus that not buying a company is better than buying the wrong one.
Absolutely.
Yeah. I think we always kind of conclude on that. You mentioned leverage and not putting too much leverage in.
Yeah.
It would be very difficult to do that, in my opinion, in the UK.
Yes, we've talked about this.
Can we maybe talk a little bit about your views on the availability of capital in the UK, and probably I'm sure we'll end up talking most about debt. What are your views on that, particularly in the SME space?
Yeah, I think, and I don't always like to compare and contrast different countries because there's reasons why certain systems are set up the way they are. But what I would say is, like in the US, if you look at the government-backed schemes, specifically the SBA loan, there are over 300 banks that specialize in this product, and they've deployed close to $30 billion of capital last year. Right. So that's pretty meaningful, and they're very entrenched in the ecosystem in that they know the Gerald Edelmans of the world. They know the institutional funds that have been in this space for decades. I don't know where that product is in the UK and Europe. Right. I know we have SEIS and EIS schemes for investing in technology startups, but I think just in that construct alone, I think the country, and also in continental Europe as well, you could benefit a lot from really providing more capital to the SME space. So that's one anecdote. The second one I'll say is also having, now started looking quite actively and investing into this space. When I talk to search fund entrepreneurs, often they say they're one of the biggest challenges once they've found a really great company, which can take 6, 9, 12, even 2 years to find, is that the lending piece takes so long to secure that sometimes that deal can actually fall apart because they haven't been able to get to the leverage in time, right? And there's also, brokers that operate in the space. And then when I then ask more specifics around terms, right? I'm hearing that on senior lending facilities, the pricing can range from 8.5% to 19.5% for the same business. And the quantum of funding is also varies a lot.
Yeah.
And it can also depend on, even within the same banking institution, depending on if you have a relationship with the person in London versus the person in Manchester, like the answers you get could be different.
Yeah.
So to me, that tells me that like there isn't enough of a structured product or like a way of how to assess risk reward on a institutional level in this space, which probably means that there's also appetite to have more funding come into this space to support these businesses, which at the end of the day is more than half of the, economy, like more than half the GDP of the continent. So I think if that's something that we can solve, maybe with a new government in place, then I think this asset class has a lot of opportunity to really take off in a big way.
Agreed. Yeah, because my next question might have been, what's the answer? But I think that's unfair.
If I knew.
That's it.
If only.
Okay, so we've talked a bit about search funds and I suppose we're using the phrase search funds. More widely, I mean, entrepreneurship through acquisition generally.
Yeah.
Obviously, a lot of investors, the OGs, the cartel, the mafia, they hopefully they don't mind me referring to them like that, but they tend to stick to traditional search fund terms, Stanford model terms.
Yeah.
Understand your appetite is more broad than that, and we work with searchers who are traditional search funds, holdcos, self-funded searchers, partnered, solo. Understand your appetite's that broad as well. Do you have a preference?
I just like backing people that take real skin and have real skin in the game. And all the things I mentioned before around deal making and also domain expertise. And I found in the interviews that I've done that and perhaps it's the folks that I've spoken to, but the self-funded searchers in the UK are really hungry. And they're really they know what they want and they're willing to take risk and put their own money to work as well. So for me, that's really interesting, especially if there is, a gap in financing in the market, which I think there is today. Doesn't mean that I would shy away from traditional search as well, because I think there's definitely a lot of merit to that model. And those types of businesses also tend to be bigger.
Yeah.
So it's lower risk from that point of view, because there's more systems and both people and operations and infrastructure to grow and scale, and therefore you can maybe the economics are smaller, but you have a smaller piece of a bigger pie.
Yeah. Whereas
self-funded searchers tend to be much smaller, so you have to grow the pie much bigger, even if you have a bigger piece of the pie. You have to grow the pie
for similar absolute returns.
Exactly. Yeah. So I think I think both are very interesting. But I do think that particularly in the UK, the self-funded model is quite appealing, mostly because of the financial markets gap.
Yeah. And so the final question, which is one that we ask everyone that comes on the podcast, is who's taught you the most on your journey, in your career?
Bit of a loaded question. So I think I've been pretty fortunate since going to study in university at Ivy and at Western, that I've tried to surround myself with, mentors or advisors, if you will, that are always one or two steps ahead in both their professional and also their personal lives. So I would say, early on, I had two really great mentors at Ivy, one called Calvin Yu, who got me my first job at JP Morgan in New York in 2009.
Right.
Great year, brilliant year to graduate.
Tough time.
And then the second is Paul Hayden, who's based in the UK, who opened a lot of doors for me when I moved from LA to London to
for the weather.
Rebuild. Yeah, definitely for the weather. to start a new life and build a new career path as well. And he's also been instrumental over the years as well. I was very fortunate to get my VC training from Felder Hardiman, who's one of the OGs in the venture space at Bessemer Venture Partners, and still talk to him quite regularly, also about search. We've had quite interesting debates around it.
Yeah.
And then more recently, in the last few years, been supported quite a bit by Shirley Perry, who is one of those rare breeds that understands technology, product, but also finance very well. She was an operating partner inside Partners for a long time. And she's also helped me in many ways on a personal level, because she's challenged me to have a very clear idea of what my number is, which I will not share on this podcast. But yeah, I think I've learned many things from all these individuals and many people that I probably haven't mentioned yet. But I think the most important thing is to always surround yourself with people that have similar values and principles.
Yeah.
And ultimately, and whether that's someone that's similar age to you or someone who's 10, 20, 30 years older, I think there's a lot of value in learning from each other.
Yeah, definitely.
And also holding yourselves accountable to promises you made yourself.
Yeah. Yeah.
1 or 2 years back. So.
Okay.
Yeah.
Joyce, thank you so much for coming on. It's been really interesting talking to you about this. I think there's been some really insightful information that you've given, and hopefully the listeners will take a lot from it.
Thank you for having me. Really enjoyed our conversation and look forward to more Carl humor in the next.
Thank you. And that's it for season 1. We hope you've enjoyed the podcast so far. Season 2 is coming soon, so get your suggestions in for guests you'd like to see me interview. Don't forget to follow us on LinkedIn at The Found and Funded Podcast and on Instagram at Found and Funded Pod. If you have any questions about what we've discussed today, drop me a message and let's have a chat.